Welcome back to Ground Rules, the show where we cut through the market noise and help you understand what really matters in agriculture. Whether you are a grower, you are trading, whether you are investing, or you're just simply really passionate about farming, we've got you covered here at Ground Rules with the latest insights shaping South Africa's grain markets. All right? And this week, international weather patterns, export demand, and production costs were dominating the conversation. While grain prices enjoyed a strong rally earlier in the week last week, the biggest story isn't just today's prices, right? It's what lies ahead for the next planting season. So let's dive right in. Here's where the major grain markets closed this week. White maize spot prices increased to 3,308 Rand per ton, while the July 2027 contract traded at 3,683 Rand per ton. Yellow maize spot prices strengthened, reaching 3,365 Rand per ton, with the July 2027 contract at 3,615 Rand per ton. Soybeans posted one of the strongest moves of the week, climbing sharply to 7,470 Rand per ton, while the May 2027 contract sits at 7,360 Rand per ton. Sunflower seed prices rose to 9,580 Rand per ton, with the May 2027 contract trading at 8,820. Wheat gained ground as well, with spot prices reaching 5,850 per ton, while the December contract is trading at 5,931 Rand per ton. Elsewhere in the market, sorghum input parity landed in Durban stands at 4,099 Rand per ton. Argentine shelled groundnuts have an export parity price of 19,000 Rand, 885 Rand per ton at Randfontein. Cotton has eased lower this week to 10,470 Rand per ton, and we see that some of the global market drivers are going to be very interesting. So what moved the market this week? Honestly, it has been a roller coaster. Grain prices surged on Tuesday and Wednesday last week, right? Before easing back towards the end of the week. But importantly, they still finished well above the previous week's lows. The biggest driver, and yes, was the US weather forecast. So July and August are critical months for America's maize and soybean crops. Earlier in the week, forecasts pointed to hotter and drier conditions, which immediately pushed Chicago grain prices higher. Later in the week, cooler and wetter forecasts then briefly removed some of that weather premium. However, now the latest models are once again showing extremely hot and dry weather conditions across key producing regions in the US over the next 7 to 14 days. And that is something that the market is going to be watching very closely. Why the weather matters? Well, timing is everything, we always say in agriculture. So a large portion of the US maize crop is currently moving through pollination, arguably the most important stage of the growing season. If these hot and dry conditions persist and rainfall disappoints, we could see that the yield potential could fall, and very quickly. All right. For soybeans, August remains also one of the most critical months in the US. So with prolonged heat, it could already begin to deplete the valuable soil moisture before the pod formation begins. In other words, the weather over the next few weeks could determine the direction of global grain prices. The wheat update Wheat also found support this week after the USDA lowered its estimates for the US wheat harvest to its smallest crop since 1970, right? American ending stocks are expected to be around 22% lower than they were last year. However, some gains remain capped by improving production prospects in Russia and Ukraine, while also the US winter wheat harvest continues to progress well. So the wheat market is balancing two opposing forces: tighter US supplies versus abundant Black Sea production. Geopolitics still matter? Absolutely. Markets are also keeping an eye firmly on the Middle East. Renewed tensions involving Iran briefly lifted oil prices. Although the markets are not yet pricing in a major disruption to the global oil supplies, the situation remains very much fluid, and any escalation could quickly influence commodity markets. So, meanwhile, our soybeans globally received another boost from soybeans, stronger Chinese purchases of US soybeans, with expectations that there could be additional buying from China in the weeks to follow. Looking back home, South African market, there is another story unfolding. Okay, we've got local grain prices remaining roughly 300 Rand per ton above deep sea export parity. South Africa continues exporting yellow maize, particularly to Vietnam, but the export momentum, we have to say, has slowed. So far, we've exported nearly 600,000 tons of yellow maize, and we've also exported around 120,000 tons of white maize. But only 235,000 tons have been booked for export over the next 8 weeks. Given the size of this year's harvest, that is relatively slow. If South Africa wants to achieve its target exports of roughly 2 million tons, then the exports will need to accelerate. Asking ourselves what could be supporting local prices moving forward? Fortunately, several factors are helping to cushion the downside. We've got higher Chicago prices, which are lifting export parity values. The harvest deliveries, they have slowed in some regions as maize continues to dry naturally. So some farmers may also choose to store grain instead of selling immediately, particularly with, the growing uncertainty around the next production season and the possibility of the return of El Nino. We see a strong beef and sheep market, which continues to support feed demand, while also we've got the economic pressure on consumers could increase demand for affordable staple foods like maize meal. If you enjoyed today's update, subscribe, share it with a fellow producer, and join us next week as we unpack the stories behind the numbers. Until then, stay informed, stay curious, and remember, the best decision begins with solid ground rules.